We got to immediately turn it into two, pull out equity, buy another one, trade it for, then turn it into four, and then an eight. And that's when that diversification, the compounding effects of the returns and the cash flow, in addition to the yield, the value can get really exciting for our investors.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Patrick, welcome to the show.
Glad to be here. Thanks, Matt.
Absolutely. Well, we like to start with the difficult questions here. What's your favorite ice cream?
Well, my favorite ice cream is a combination of ice creams because my grandfather one day said, "Hey, I'm going to go teach you how to eat ice cream today." And he took me to 31 flavors and he ordered a banana royal with cookies and cream, mint chip, and caramel, whipped cream, nuts, and a cherry. And anytime I go for ice cream and I want great ice cream, that's exactly what I order to this day. And I know exactly where they're located here on the Waikiki Strip behind me. So,
that sounds like a man I need to know if he was that specific with his ice cream order and that many flavors and combined in one.
Yeah. And man after my own heart, because that's what I do now today.
Love it. Love it. Well, tell our listeners, what's the scoop? What do you do today?
Well, we have Invest on Main Street. I'm the CEO and founder. We're a private equity firm. We put together investments in alternative assets. That just means that if you've been working really hard like I did as a professional, I was an engineer, and a lot of my investors are doctors or attorneys or entrepreneurs or business people that are following the traditional path, putting stuff away in 401ks and IRAs and qualified plans, but kind of tired of the roller coaster of the stock market, which all of those have you in. They want to invest into something that will accelerate retirement and grow throughout retirement. And that's what we provide in non-correlated investments outside of the stock market. Little better protection from things like taxes and interest rates and inflation and more recession resilient.
You had me at protection against taxes as I'm now paying my tax bill for 2022. But before we get into all of that, you have an interesting backstory of your real estate journey. Could you take us back? Where did your real estate journey begin?
Out of college, I was a mechanical design engineer. And the automation company I worked for as a mechanical engineer, the founder said that his only regret wasn't going further and deeper into high tech. It was not investing more sooner into real estate. And so I took that to heart. I read the Purple Book, the Rich Dad, Poor Dad book, really fell into that. But I was not very conservative back then. So I was looking for the highest returning deal, wanting to double and triple my money, young and eager. I did a pre-development right in 2007, 8, and lost everything in 9 and 10 and learned a lot of hard lessons. And so that's how it began. So it's a little bit rocky.
So when you say pre-development, were you actually the one developing the property? Were you involved in a bigger group that was doing that? What did that look like?
Yeah, so I worked with a developer and I bought the land myself, personally guaranteed it in my own name, put up the capital. And it was unfortunately a recourse loan, meaning they can come after me personally. And it was in a recourse state that lets you do that. I was also liable too because I signed on the property in my own name, which means somebody tripped and fell or there was an injury in the build, they could come after me personally. I didn't know about asset protection. I have a Forbes article on that. Asset protection, which kind of addresses a lot of these things that I learned. But it was a lot of lessons very early on and kind of set the tone for me and humbled me and got me on the path of the tortoise and not the hare.
Yeah. Usually we don't know what we don't know until something like this happens. I'm wondering if you can look at it from a 2023 perspective, what would you say to yourself in 2007? Because obviously investing in anything has its inherent risk. You felt like you were doing the right things, but it kind of didn't work out for you on the first deal. What's kind of the gotcha or the something that you would have pointed to yourself now knowing what you know?
Well, I was speculating. I was not investing. I wasn't buying cash flowing assets that could support themselves and stand alone. I was hoping. I was buying something and I hoped that I could develop the land to be built on. I hoped that I could build on it. And I hoped that by the time I got through all that, I didn't run out of money because it didn't self-support itself economically. And I hope that by the time I got to the end, there was a market that would want to buy and or rent what I had on that property. A lot of hoping and a lot of ways for one card to fall out of that. Whereas nowadays, buying larger apartments and partnering up with individuals with a lot of experience, the advice I give, what I would have given myself back then is to find more experienced people that are doing low risk things, partner up, learn as much as you can, and don't try to be the DIY investor that could end up losing it all.
Yeah, I was telling an investor the other day who was like, why would I do this passively when actively I could return so much more on my capital? And I'm like, active real estate is hard. No matter who tries to tell you it's not, if they're telling you it's not, they probably only been involved in real estate for the past 3 years. But active real estate is very, very difficult. So you had this event that kind of unwound around 2010 timeframe. What was your next deal from there? Did you get involved actively again? Did you partner up with folks? What did that look like?
So I kind of ducked back into my high tech career at that point. It took me a number of years to recover. I got a master's in engineering and business. I started doing very well again in the high tech space, automation for places like Tesla, SpaceX, Lockheed. Did a bunch of really cool projects. Started making some pretty big bonuses and looking for the best place to invest. Still had the voice in the back of my head that I needed to start buying cash flowing assets, needed to start diversifying out of the stock market, and didn't want to bet at all on the high tech companies I was working with. So after a lot of research and kind of analyzing, going to investing conferences, reading books, I learned about recession resilient markets. I learned about asset protection, buying things in entities. I learned about, non-recourse debt products that they don't come after you personally. And I learned about buying markets where you could buy something that cash flows. I'm in California. I was raised in California. You can't just buy something that cash flows. Learn about doing it like in places like the Southeastern States. But I was still doing it on my own. So I started single family. I started buying single family homes that were distressed, but could quickly cash flow with a small infusion of capital. And that allowed me to create some immediate equity. It allowed me to have something that stood on its own, that was proven because it was there and had been there for decades, and the nearby rental comps were very clear. But then I was very successful. I grew a portfolio of single family homes before I realized that I was spending a lot of my nights and weekends. I mean, on the TV, they glamorize the whole idea of being the DIY flipper, right? and trying to, make a quick 20, 40 grand or whatever it is here or there, flipping homes. Turns out if you're a successful professional and you spend a lot of your career being great at something, which is the reason you have money, doing that again in another place and then spending your nights and weekends on that, it's very subtractive. It's exhausting. And it's also more risky because you don't know what you're doing. And so I, at that point, had to put it on pause when I met my soon-to-be wife because I needed my nights and weekends back. And I did that, married her. And then afterwards, we changed our strategy to partnering and trading up into larger assets.
Yeah. Do you, so I have this conversation with investors all the time around like active investing versus passive investing. And my general rule of thumb is that if you're a highly compensated sales professional, entrepreneur, doctor, attorney, whatever it is, you've built a very lucrative skill set. To do it actively has to have outsized gains, returns to be able to take on the risk, as well as learning a whole new skill set. Because just because you're smart in one area doesn't mean that you could do it in another. What's your general rule of thumb if you're looking at taking an active deal or a passive deal? Like, how do you think through that, or how did you think through that at that time?
Well, if you go to Forbes Asset Protection, Patrick Grimes, and Forbes Single Family versus Multifamily, Patrick Grimes, those are two articles I'd recommend. I've got a bunch out there, but those are two that kind of address those two concepts on active versus passive. And the reality is that if you're going at it about it yourself, it's another job. So first of all, it may look glamorized on TV, but it's a lot of work. And most of the people that get in the active role, they have a big dropout. You talk to the gurus charging 10, 40 grand for these coaching practices, they'll tell you about 90% they have washout. People just don't realize that they don't want to work hard again to create something all over again. Those individuals end up being really good passive investors for the gurus and very knowledgeable. So I'm not a guru. I mean, I put a lot of content out there and I got a best-selling book and stuff, but also the risks are much higher. If you have great income and you're doing well, when you're an active guy, you're unlimitedly liable, like you are with your single family home now. If you bought a single family home, bought it in your own name, you signed on a loan in your own name to get better mortgage rates, you're unlimitedly liable for a lawsuit there. You don't want to include that same liability to all of your investments. And as a passive investor in our deals, you're the limited partner, limited in your risk to how much capital you have in the deal. So unlike my first investment back in 2008 when I lost everything and then they came after me personally, the syndication investors, the LP investors that invest in our deals, they'll be able to we have 26 some properties all over the Southeastern states, the Midwest. They'll be able to take and invest as a small piece partner. Each of those investments stand separate from each other. They're protected from each other. And you're protected from them because each of those are in LLCs. And you're not signing on those properties in your own name. So you're not going to be on a liability lawsuit. You're also not signing on the loans in your own name. So you're not going to be responsible for the debt that's taken out. But you get all the benefits, oftentimes similar returns as going out and doing it yourself. You get better tax advantages because we take on bigger assets that are more favorably taxed. And you get your time back, which means you can now spend your time looking for another partner to trade up with rather than spending time learning another profession, again, which you probably won't be as passionate about as the stuff you'd rather be doing with your time. And that was just my story. And I think there's a lot of people out there that may be like, no, I hate what I do. I want to become active. Well, go for it. Just go for it with your eyes wide open. That it's a lot of work. It's risky. And when you get heavy into it, it's going to take so much time. It might sacrifice the thing that's actually carrying you forward in your job. And it most certainly will sacrifice the time from your family and hobbies. Ask any active guy. That's what it's like.
That's it. And just to repeat a little bit about what you said, because I thought it was very valuable. You're, as a limited partner, when you're in these deals, you're only limited to the capital that you have in the deal. So if there's any sorts of recourse on the loan, you're not on the hook. If there's any sorts of incidences on the property where there's legal action that needs to be taken, they don't even know you exist. You have no risk involved in that. And I think that's important for people to think about, because I think in real estate, you've been in this business long enough to know that it's not a matter of if you're going to get sued, it's a matter of when you're going to get sued. So if you can limit your exposure to those types of lawsuits, especially if you're like a doctor, then that's probably a good thing to at least explore rather than doing this thing actively.
Yep. You nailed it.
Looking at your portfolio now, can you tell our listeners, what does your portfolio look like today?
Well, we have over 500 million in acquired value add deals. So that'd be about 26 properties, mostly over 200 units, some a little smaller, that are 20 to 50 years old for the most part. Ones that we were able to pick up at a discount that need renovations, fall below the nearby market rental rates. And so we do value add, and we were able to pick those up and then improve our investors' returns through renovations. So that's what we've been building for some time. We also have some energy funds out there to help diversify in a completely non-correlated asset. And we have some additional investments coming on geared around the recession that we're in right now. And many of the deals that we were going after before in the last decade are no longer advantageous to do so. We built a recessionary resilient portfolio, which will ride out this recession, but it doesn't mean we want to go after the same deals in the same way during this recession. And so what's exciting right now is we're building the recessionary acquisitions fund, which takes on a wholly different strategy to pick up as many deals as we can during this time that we can just make our return on buying right. And it's not it's not mysterious. I mean, it's a lot of what the billionaires did when they bought in 2009, or what created billionaires were the people that bought things in 2009 and 10 when others were fearful. They were greedy, as Warren Buffett says. And I was just scraping to stay alive at that point because I had just lost everything. But this time around, we've got the right strength in our portfolio, and we have very eager investors to participate while the tide recedes in real estate, to participate in some of these incredible buys, and we can ride some of those waves in.
Hey, fellow investors, before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
So talk to us a little bit about the recessionary acquisitions fund you put together. Is this going to be mezz debt, pref debt on top of acquisitions that have already happened and GPs that are in a tough spot? Or are you looking to scoop up new properties that maybe hit the market at a discounted valuation?
Right. So right now, what you see is a lot of distressed owners, distressed operators that are now looking at becoming distressed sellers. It's not necessarily that the assets and the buildings are bad. They're actually strong buildings, but the owners need out. They need relief right away. And we're looking with the Recessionary Acquisitions Fund right now, and we do have complement, which would be more the debt fund focused in the future. But right now, the Recessionary Acquisition Fund, we're not looking for long-term value add holds. We're not looking to partner with sponsors. We're looking to scoop up properties, mostly direct to owner, that we know that we can get in, we can get our capital out right away. We can make our return right away. So we can move quickly. As soon as we pick up this property, we can backfill it with 50% loan to value, very low leverage. We can use that to buy a subsequent property, execute our plan on the first, and within as few as a few months to a year, trade that forward, doing tax deferred exchanges into another one that we can buy. And we know in each of these, we know that we're not focusing on getting the return through a long multiple year renovation strategy and hoping that our rents grow. We're not hoping that our renovation budgets stay under control. We're not hoping that the market doesn't depreciate. We're doing shorter term holds, making the return on the buy, stepping it forward, making the return on the buy, trading it forward. And within the fund, that's when things get really exciting, because we didn't have that kind of deal flow for those kind of buys 1 or 2 or 3 years ago. And it may be that in 1, 2, or 3 years ago from now, we can't find that deal flow to buy those kinds of deals without having to do value add and get the returns. But what's exciting is right now you can. So we got to move fast. We got to be agile. We got to buy these properties. We got to immediately turn it into 2. Pull out equity, buy another one, trade it forward, then turn it into 4, and then an 8. And that's when that diversification, the compounding effects of the returns and the cash flow, in addition to the yield, the value, can get really exciting for our investors.
How long is the fund going to be open for?
We're going to keep playing this as long as we can continue to find the deals. We've been able to find the deals, and there's been 4 acquisitions with the strategy outside of the fund that has proved to us that we can do our strategy enough to demonstrate to investors, like, let's do this in a fund. If we do it in a fund, we can move faster and we can trade forward. Now that deal flow is very strong right now. We're seeing right now, I don't know if you've seen, the Bloomberg just put out an article that there's $1 trillion debt wall coming, where there's going to be so many different operators needing out immediately. And it's not that the assets are weak. It's just they weren't prepared. They didn't have fixed long-term interest. They didn't have low enough leverage. They didn't have enough reserves. For whatever reason, it's the owner that needs out. It's not that the asset's bad. We can jump onto that train. So it's going to be very strong for the next year, maybe 2. It'll start to taper down. But the faster we move, the more we'll be able to scoop up.
Do you have certain markets that you're looking for this fund? Or are you just looking for good quality buildings with distressed owners?
It's a good question. There are, to execute the business plan, there are certain things we're looking for. So there are specific markets that we're able to find the types of deals we're looking for in more than others. So we have, but for the most part, we're much more open than we would typically be in our normal value add play strategy. And the reason is because when you're buying a property to spend years setting up shop and improving it, you have a lot of concern over the long-term steady state growth, a lot of concern over the influx and outflux of people. You have a lot of concern for the ability to hire good property management that's going to turn over. Whereas in this asset, we're actually making the return on the buy. Maybe we're doing some light stabilization of that asset, but then we're immediately focusing on trading it forward. So we're not as discerning about all the normal things, but we do have markets we have more experience in, which tend to be the more Southeastern landlord-friendly Midwest types of areas.
And you said direct to seller is kind of how you're going to approach this strategy, or direct to owner, I guess would be a better term there.
Yeah. So the issue right now, there's a lot less trading in real estate. Yep. And the reason why is because the sellers have these expectations that prices haven't gone down. If they talk to a broker, the brokers are not really good at convincing them. The brokers just want their business. And so the brokers will come in and be like, hey, look, I can get you this price. And then they'll go shop it and everybody says no. Well, now you've got an owner with the wrong expectation set. So it is true that we're getting some off-market deals from brokers. But it is true that we're going to target as our primary source. We have specific software and an acquisitions engine that does target directly to the owners so that we can move very quickly and we can scoop these up. And they're a little bit like whack-a-mole when you find them, right? You gotta move quick before it disappears. But brokers, we have a lot of broker friends. And it's not a knock on brokers. It's just that in this particular day and age, getting these kinds of deals, it's better to go direct.
Yeah. And I want to put some context around this. Like everybody right now, if you own multifamily or any kind of big commercial asset, your expectation is anchored in 2021 prices or 2022 prices. We haven't seen a ton of trades in the multifamily market this year. So because of that, there's price discovery. We don't know what things should be trading for or what they will be trading for. But if I'm an owner, my expectation is rooted into 2022. So like our strategy has been, we built a pretty good portfolio. We believe that brokers will remember that we can close quickly, and we've got the capital to go do those sorts of things. But to your point, if it gets to that broker stage, then chances are the seller has their expectations set again unreasonably, because a broker's trying to win business, as well as theirs is based off of a percentage of the selling price. So obviously they're going to want to try to sell it for higher. So I'm very interested in your strategy and how you're approaching this, and maybe we could talk about it offline, but I think this is a good opportunity for this type of fund vehicle to go find distressed owners right now and make some good quality acquisitions.
Yeah, I think you said it very well. It's not dissimilar from what all the single family wholesalers are doing, right? They're just better marketers. But it's not that common that we can pick up commercial assets at these kinds of discounts. We have before. For example, we picked up an asset in Canopy Creek, was the name of the asset in Jacksonville, Florida, a little over 200 units. And one of the owners was very ill, was an off-market kind of tip we got that they may want to exit, and very quickly. We used a family office to pick up and pay for the entire acquisition. We backfilled it with a capital raise from accredited investors in a syndication. We sold it 10 months later for $10 million gain. We had bought it for $27 million, sold it for $37 million. It's not, we've done this before on larger assets, and it's not dissimilar from these other strategies. It's just more common now, and the deal flow is there now to actually create a fund around it, rather than this just be kind of the odd, like, random win, right? And just to apply the basic principles that we've been doing before, but to scale it at this time.
Yeah. What, $10 million gain on a $26 million acquisition. I don't know. That's at the risk of running public math. That sounds like a 40% return. That's not bad in 10 months.
Yeah, it was quite a bit higher because there was some leverage. But yeah, it went very well, and we 1031 exchange our investors into a subsequent investment in Houston, and in this fund, that's exactly what we're doing, with the ability to just bring in the capital, close quick, and then do a 1031 exchange to an immediate next asset. We'll do a refi, and then a 1031 exchange allows us for that agility to move much faster. And some people are like, well, wait a minute, if you sell an asset, I get profit, right? Well, that's the whole point of this fund, is we'll distribute cash flow. But the whole point of this fund is to use that, keep recirculating that capital back in, and continue to buy very quickly more and more assets. And so that cash flow begins to compound, your yield begins to compound. And that's when it gets real exciting. Every year, it gets much higher. So the underwriting for it is, it's going to be a lot of fun. And you can see if you look at the assets we've acquired outside the fund, that kind of demonstrate our ability to meet the returns and what timeline we're able to meet them. It's the proof's in the pudding, right? It's something that we can do. We're just going to scale it.
Yeah. Well, Patrick, we have a lot of listeners of our show that are limited partner investors. They're listening to this. They've heard about real estate. They want to get involved. But you're a guy that's been through the booms of the 2020s, 21, 22 time periods, and the bust of the 2007 to 13 time period, let's call it. If I'm a new investor right now, I want to get involved in real estate as a limited partner. How do I navigate this space? I hear a lot of doom and gloom and recessions and geopolitical instances and election coming up in 2024 and this mounting debt wave that's coming. How do I navigate this sort of environment right now?
You duck and hide and cover. I think that's what the people on the news want you to do. But no, I mean, you think about what year could you not ask that question? And it'd be because there's always this fear mongering going on in the world. And no matter what year, there's always going to be something that's going to cause you to go duck and cover. And it's true, I've lost my hair. I've been through it. Yeah, I don't have any hair left, but I've been through it. So and each recession is a little different. I just did a presentation on how we fortified our deals from past recessions to ride out recessions. But then now here's a new recession with different things and what you need to do differently. So what you need to do is find operators, find partners like us that, to Matt's point, have been through it, have seen downturns, have seen how the economics can shift, have seen how the demand can shift, and that can speak towards or are speaking towards an appreciation for that. And they'll have a long conversation with you about how they fortify their deals for the unknown future, uncertainty events that may have occurred like they did in the past. And when you can have a great conversation with somebody and they understand your questions, I think you're on the right track. I look for a lot of people with track records. They'll let you talk to their investors. It's important. I wouldn't look so much as the people that are necessarily on stages and getting out there and getting the message or selling coaching packages. I look for more people that have done the deals, have the track record, can show the proofs in the pudding, and have been around long enough to show that they have the fight to stay in the game, and they're a little humble. I mean, there's still people out there doing a lot of deals as if we're not in a very challenging time, which we're obviously in a very challenging time. That's why there's an opportunity. It's because we're in a challenging time. And, if you duck and cover right now, you're going to be kicking yourself because, man, I wish that I had been available. I wish I hadn't been too greedy, too young. I wish I had my funds to invest and I had taken the tortoise approach and not lost it all in the first recession before, but I had the ability to take advantage of the good deals coming out of the '08 bust. And so this is that other chance. This is that chance. You don't want to miss it. It's been 2 decades, right, since we've seen an opportunity kind of like this. So I'd muster up the courage and get on the phone, talk to sponsors, see what they're doing, and give it a shot.
Yeah, I think a lot of those people I would point towards the 2010s, 2011 time periods when we all were scared with what's going on with real estate. We felt in 2015 that real estate was too high. And if you sat on the sideline for the past 8 years, I mean, you missed out on a huge bull run. So I'm not saying that the next 8 years will replicate that, but I certainly will say that 30 years from now, real estate in major metropolitan areas will probably be more expensive than it is today. So getting with the right operators in the right markets is always a good long-term strategy to navigate tough times.
Agreed.
Patrick, I want to take us now to our last round. I'm calling this the 5 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
So I'm going to go with recently. A CEO Does These 3 Things by Trey Taylor. He's an awesome guy, and I run every morning. I'm a runner, and I always listen to, I'm a big subscriber to the Miracle Morning. I listen to educational content, whether it be podcasts, audiobooks, TED Talks, always looking for that. This book, if you're serious about leading your organization and you're a CEO, I think you should read it or listen to it 3 to 5 times, because each time I go, it's so densely packed with great stuff, great analogies and stories. It's a lot of really good content that really help to brighten up my organization and sharpen my direction on what I should be doing.
How long are your runs in the morning?
It depends. As I get older,
the right
they're
answer.
shortening. It used to be like 5, 6, 7 miles, and now they're maybe like 2 to 4 miles, depending. And when I'm in Hawaii, like I am now, I often will either run to my surfboard or I'll run with a snorkel, just to change things up a little bit and hop in.
There you go. We'll nerd out on some running after this then. Our second one is, I believe the person you become 10 years from now is directly correlated to the habits that you have and the things you do every day. What are some of the habits that you have every day?
Well, I shaved my head, the remaining hair on my head. Yeah, my habits are more around making sure that I do my Miracle Morning routine. I spend my time in silence. I spend my time with affirmations. I spend my time on my runs while simultaneously listening. And then I do take fervent notes. I've got 2 master's degrees, so I learn a lot. I write a lot. I've got a lot of stuff out, so I scribe as well. And then my wife and I carve out time on my calendar where I get to spend time with our little newborn, Emery, 7 months, and I get to do that at lunchtime, and then in the evening. And then my wife and I will go on walks in the evening, spend some time with each other. In fact, just before this podcast, I was able to join her on a walk to walk over to the aquarium, and I had to hustle back. So you got to take that time out with the family.
Absolutely. Absolutely. You only get it once. Our third one is, what is the best piece of advice you've ever received?
I've received so much good advice. This is a tough one. Well, I've already shared the one that kind of spurred me down the road. And, my regret was only to invest more sooner into real estate. One thing that I probably would say is that I was told by a mentor who looked at me, and being the engineer, I constantly keep my head to the grinding wheel and just get the work done. I didn't get my name out there. And he explained to me that I've been through a lot. I had a lot of stories, and I had a lot of things that would relate to people and help them on their journey. And he told me that investors make a decision to invest upon trust, which is an emotional response, upon the relatability of that person and how they see that happen for their lives too. And then they justify that decision with logic. And as an engineer, I was very, data-driven, logic-oriented, and I had a lot of success because I had a lot of engineers investing with me. But in order for me to get my story out, I had to get vulnerable, and I had to share my failures like I did today. And I had to explain what I went through, and that I was once a professional slaving away, and then I could make a better impact on people's lives, and I could shift their mindset. And a lot of people don't know they have a mindset shift. They need one. If they need one, they don't know that they need one. And so you got to be that relatable person. And that kind of transformed who I was, because turns out once I got out of my hobbit hole, my engineering hobbit hole, and I got in front of people, it became a lot more fun.
Yeah. And I think you're right. People make decisions instantaneously, gut and emotion wise, and then go back and justify it. And it's hard to not
Mhm.
see, like, why are you doing it this way when that's the way they make decisions? Our fourth
Right.
one is, what are you most proud of in your life?
I think I'm most proud of the fact that um, I've now gotten to a point where, like, for example, during COVID, we were struggling with where we lived, which was a beautiful spot, but we were quarantined like everybody else. But we were also um, in the middle of riots in Southern California. We were also curfewed. And then there was fire. So it's in times like those when it's like, wow, it was a little bit rough, like it was for everybody. But we had worked hard and gotten freedom, financial freedom. We had worked hard and we had gotten location freedom. And my wife came out and said one day, "Hey, I was talking to some people, and what about moving to Hawaii?" 2.5 weeks later, I had us on a plane. And the ability we worked hard for a lot of years to be able to have the freedoms that we have. And I would love to help create other investors, other professionals to help them along that path as well, because it wasn't until we started investing passively and creating that steps towards streams of income, which are outside of the day job, where any of that was possible. So that's perhaps where I feel like I'm most proud of that. Now I get to spend that time with my family. I get to have the freedom to be where we want to be and give back to causes that I care about, because I'm not so inundated by a boss like I was back then.
Yeah. Yeah. I think that's the dream for everybody. Our fifth and last one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
It's got to be Elon Musk, because man, he is just one of the. And I've actually done some robotic projects with his team, and I've heard that he's actually looked at and scrutinized, some of like the rotor assembly robotic cell that I worked on as an engineer, but we've never met. Man, he's such a peculiar guy, man after my own heart, and I'd love to sit down and have a conversation with him and just understand what makes him tick, and what ideas he has for AI that could transform the investing space.
As a engineer, I kind of thought you were going to go that route.
Oh, okay. Yeah, very predictable.
Well, he's the number one person that's mentioned on that question so far.
Oh, interesting. Okay.
Yeah. Well, Patrick, fantastic conversation. If our listeners wanted to reach out to you, learn more about the recessionary fund, the recessionary acquisition fund, or get a free copy of your book, where is the best place we could point them?
Yeah. So Persistence, Pivots, and Game Changers is the name of the book. You go to invest on Main and then Street, investonmainandthenstreet.com/book. And you'll get to the secret link. That secret link is where I offer a free copy of my book, a hard copy. I actually signed them and we send them out. And Persistence, Pivots, and Game Changers, it was a collaborative book. I did a chapter along with the lead guitarist at Def Leppard, some NFL, NBA players, entrepreneurs. It was just a really fun, a lot of rock stars in there, literally, and some others like me that kind of tell it all. And I tell my whole story. And I'd be happy as it was a bestseller. And I like the fact that I get good feedback from people that read it. So I'm happy to give you shoot out a free copy of that signed. If you want to go there, I love being able to talk to investors. It's one of the things I love about this business. So if anybody would like to set up a call, we do have 100,000 minimums, and we are limited to accredited investors in our investments. Now, even if you don't meet those criteria, I'd be happy to talk with you. I know others that have smaller minimums and deal with accredited investors, non-accredited investors. So if you want to go to investonmainstreet.com/contact, investonmainstreet.com/contact, set up a call. You can see my calendar right there. I know I have times each week, and I'd be happy to sit down with you, understand your goals, and get you pointed in the right direction.
Awesome. We will leave all those in the show notes. And then Patrick, thanks for coming on.
Thanks, Matt.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.